Well, hello again, Solis Wealth family. Greg Solis here with our update. First of all, on the family front, we had Nicole in town last week. Oh my gosh, I love having her in town. The girls went to Coachella. That's a big festival that they have here in the desert. Big deal. I mean, literally over 100,000 people go to that, and then they'll do it weekend one and weekend two, and then the third weekend they actually do what they call stagecoach. So this is a big week here in the desert with all these festivals, and great having the kids around. Just a lot of fun, a lot of neat things going on. Also, what was really cool is sunrise service. We had our first inaugural sunrise service at our club, and oh my gosh, it was gorgeous, just absolutely beautiful. Probably 250 people showed up. Really a highlight. That was the first time we had done it at the Hideaway, and boy, it was just a great experience. So good stuff going on. Market-wise, well, it was a better couple of weeks. The Fed came out. The minutes came out last week. They talked now a lot about recession. Of course, we were talking a lot about inflation, still a concern, but there's definitely signs of things weakening and getting not as strong. Employment numbers are definitely getting a little softer. As a matter of fact, for the first time in a while, they had a surprise on unemployment claims last week. So those are good signs. They sound bad, but they're actually good because it's shown that the labor markets are not quite as strong, which of course will help the pressures come down on employment numbers. So those are good things, good signs happening. We're seeing the 10-year Treasury has come down quite a bit. We're down to about, it got as high as 4.25. We're right around 3.4%. But the short end is still pretty high. So the 3-month Treasury is up over 4.7, 4.8%. So we still have that inverted yield curve, but the Fed did talk about potentially having a mild recession in the latter part of 2023, which is what our base case has been all along. So that's not surprising to us, but the market did sell off a little bit on that news. But then, of course, it looks as though maybe they will only have to raise rates one more time in May. So we're expecting about a 25 basis point or 0.25% increase in May. And then most are starting to talk about them starting to reduce the Fed funds rate in the latter part of 2023. So that's what's going on. Again, a little bit of that good news being bad news and bad news being good news. And it's just this balancing act of trying to calm down inflation, slow the economy down, but not throw us into a deep recession. So we still feel that a soft landing is possible. And we think that we'll start to see the Fed lower rates. The equity markets have already pretty much priced in a recession, we believe. So but the S&P 500 is still off about 15% from its high that it hit back in 2021. And so we got a ways to go to get back to our all-time high. But we bounced back pretty good from March 15th after the bank debacle. So the banks seem to be stabilizing, but there's a lot we're watching that very closely. Their balance sheets are a little off, and of course, we're seeing some deposits coming out. Deposits aren't as strong. We're seeing some withdrawals. And so that could cause some challenges for the banks. But the Fed has made it clear that they're going to back the banks. We do recommend anything over $250,000 that's not FDIC insured. You probably want to just be careful there. But other than that, things are looking a little bit better. We're, again, optimistic that 2023 will be a good year. But if you have questions, anything we could do for you, we're here for you. Take care. God bless.